Are you a lazy fuck? Great, awesome. Then this video is for you.
Sending flowers to me. Flowers today, flowers today. Instead of sending flowers, come back to me and hold me in your arms again.
Welcome back to my channel, boys and girls. Thank you so much for clicking on this video. My name is Fatty, aka Whatup Shifter, and what we do on this channel is we talk about everything that has to do with money, but we do it in the most simple terms. And we do that because we want everybody to understand. And when everybody understands, everybody can make money. And then we're actually all in this together. So let's get on to the video. Today, we're talking about ETFs. ETFs stand for Exchange Traded Funds. Sounds boring, right? Well, cause it is. It's really boring. And it's probably the most laziest investment out there. And the reason for why I say that is because ETFs are the type of investment where if you have any disposable income at the end of the month, you take that money, throw it in the ETF, and completely forget that it's there and let it do its work in the long term. So if you're looking for a video that's gonna get you 300 to 400% returns in a month, this ain't it, buddy. But if you're looking for a video that's gonna get you really good returns in a long period of time with disposable income that you're probably just gonna save anyways and lose money with inflation, this is the video for you. So the way this video is gonna be laid out is in the beginning of the video, we're gonna go ahead and talk about what ETFs are, how they work, and where to buy them. And in the second part of the video, we're gonna go ahead and talk about my personal top 3 ETFs that I like to buy and why I like to buy them. So let's get on to the video. I know a lot of people are actually confused with what stocks, ETFs, and bonds are and what differentiates them. So let me get you guys unconfused. Put it simply, stocks are a one individual share or stock ownership of a company. So if you wanna go ahead and buy Apple, you can go ahead and buy one share at $127 and you'll be owning equity in Apple. Now, ETFs on the other hand are actually a group of stocks that are in one ETF. So if you buy, say, VOO tracks the S&P 500. So if you buy VOO, you'll probably find stocks like Amazon, Apple, Microsoft, Tesla, all in one ETF. So it's a very efficient way of buying stocks because technically you own most of these stocks by paying one price instead of paying one price for one individual stock. The upside of having an ETF in your portfolio is if one stock in that ETF doesn't do well, the other will probably pick up the slack for it, and vice versa. So when you buy individual stocks, you're hoping that that individual stock does well, and if it doesn't do well, your portfolio will be in the minus. So that's the difference between stocks and ETFs. I hope that's clear. Most ETFs have a certain goal. You can buy an ETF that tracks the S&P 500. So S&P 500 is the 500 best companies in the United States of America that you can go ahead and invest in. You can buy a ETF that tracks wheat stocks. So if you're interested in wheat stocks, you can buy a bunch of wheat stocks in one ETF. You can buy an ETF that tracks the total stock market in the United States of America. So all the stocks in the US. And you can pay one price and invest in all of them. So every single ETF has a specific purpose and goal in your investing portfolio. But wait, it gets better. ETFs actually become an investment on steroids because of one thing and one thing only. ETFs utilize compound interest. And if you don't know what compound interest, I'm gonna give you the actual definition for it so we can all be on the same page. Compound interest is straight up the interest calculated on both the initial principal and the accumulated interest from previous periods while still adding capital over time. So that means if you invest $1,000 in an ETF and you make, say, $100 in 1 year, the next year your interest is gonna be calculated not on $1,000, but $1,100. Now, for you guys to really understand what I'm talking about and how powerful compound interest is, let's go on my calculator, my compound interest calculator, and see how this all works and how it will affect your investment over time. So let's start with an initial investment of $1,000. Let's be modest. And then go ahead and regularly add $200. And let's go ahead and put in a benchmark interest rate of 8%. That you can regularly get in an ETF, honestly. And let's go ahead and put in interest is compounded in yearly, so 8% yearly. And let's go ahead and see our years to grow. Let's put in 20 years. So if we calculate that, Our total investment over 20 years will be $118,460, starting with a $1,000 investment over 20 years. This is the power of compound interest. This is how the rich keep getting richer. Another point I really wanted to make is that investing in ETFs can be a rather safe investment in the long term, depending on the ETF you invest in. And the reason for why I say that is because in the short term, major drops in the share price will not matter. In the short term, major rises in the share price will not matter. The only thing that matters with ETFs is the performance of the ETF in the long term. So to really make you guys understand, let's talk about unrealized gains and unrealized losses. Unrealized gains and unrealized losses are if the price goes above how much you bought it, or if the price goes down below how much you bought it and you don't actually sell, then you didn't actually take a loss or make a gain, because the price can fluctuate again and go back up or go back down. So you will only lose or make a gain when you have realized gains or realized losses. And the reason for why I'm telling you this is because if you're investing in the long term, what happens in the share price in the short term, if it drops or goes up, doesn't matter. You still don't believe me that this is a great investment for the long term? That's cool, no problem, no hard feelings. Check out what my boy Warren Buffett had to say about ETFs.
Of all the things that have happened since 1942, we've had 14 presidents, 7 Republicans, 7 Democrats. We've had world wars. We had 9/11. We had the Cuban Missile Crisis. We have all kinds of things. The best single thing you could have done on March 11th, 1942, when I bought my first stock, was just buy an index fund and never look at a headline, never think about stocks anymore. Just like you would do if you bought a farm. You just buy the farm and let the tenant farmer run it for you. And I pointed out that if you'd put $10,000 in an index fund that reinvested dividends, and I paused for a moment to let the audience try and guess how much it amounted to, and it would come to $51 million now. And the only thing you had to really believe in then is that America would win the war and that America would progress as it has ever since 1776, and that American business, if America moved forward, American business would move forward. You didn't have to worry about what stock to buy. You didn't have to worry what day to get in and out. You didn't know the Federal Reserve would exist, whatever it might be. And America works.
All right, now it's time to check out my top 3 ETFs that I personally like to invest in. All right, so our first ETF that we're gonna go ahead and talk about is ticker symbol VOO, one of my personal favorite ETFs. I love it. This ETF actually tracks the S&P 500, which is the 500 best US companies out there. So it does pretty well over a long period of time. The first thing you should look at when you're looking at an ETF is the expense ratio. Now, the expense ratio, to be honest, is a management fee. That's really what it means. That's the amount that they take out of your invested capital. So let's say you go ahead and put in $1,000. They will take out 0.03% of that $1,000. So make sure you do your math before you're investing. But to be honest with you, this is a very, very low expense ratio for an ETF of this quality. Let's talk about VOO's performance over the years. And since this fund was actually created, VOO has returned 15% average every single year. Now let's go ahead and put it in perspective. If you had kept that money in a savings account, that gives you 1%. Inflation rate is very real, guys. 1.6% is inflation rate. 1% minus 1.6% is 0.6%. That means you guys would be losing 0.6% on your money every single year if you kept it in a savings account. But if you took it from a savings account and put it in an ETF, you would actually be making 15% on your money year over year. This is how the rich get rich, guys. So the second ETF I would like to show you guys is, again, one of my personal favorites. We saw it earlier in the video. It's ticker symbol VTI. This ETF tracks the total stock market in the United States of America. So if you believe that in the United States of America, the economy will continue to go up, then this is the ETF for you. The expense ratio, which we saw earlier, is a management fee, is 0.03% on your capital that you invested. So again, do your math before you're investing. So let's talk about VTI's performance over the years. VTI, since they created the fund, has returned on average 8%, actually more than 8%, 8.25% a year on your money. Again, let's go back to our example. If you had kept that money in a savings account, that gives you 1%. Inflation rate is still there. So if you do 1% minus 1.6, you're still losing 0.6% on your money if you leave it in a savings account. Just take that money, throw it in an ETF, throw it in this specific ETF, and make 8.25%. It's a no-brainer, guys. You gotta be smarter with your money. Our third ETF that is one of my personal favorites is ticker symbol HDV, iShares Core High Dividend ETF. This is a high dividend ETF and I love it. You work really hard to buy these stocks, these ETFs. Let these stocks and ETFs pay you. The dividend yield on this ETF is 4.07%, which is nuts. But there is a caveat. The expense ratio is a little bit higher than the ones that we saw before. It's 0.08% on the initial capital that you invested. However, it cancels out and more because the other ones that I showed you have lower dividend yields compared to this. So now let's look at HDV's performance since it was created. HDV has returned 9.6% every single year on its investors' money plus its dividend, which is awesome. It's a no-brainer, guys. This is the way to manage your money. Have it work for you. So all in all, guys, please, if you have money laying around, don't leave it in a savings account for years and years and years and years and years. You'll be losing a lot of money. Guys, inflation rate is extremely real and it's not your friend. Go take that money, throw it in an ETF that you believe is not that risky. I mean, if you want to risk your money, go ahead. But throw it in an ETF that's not as risky, that can help you grow your money instead of lose your money every single year. Thank you so much for watching, guys. I really appreciate each and every one of you guys. We actually surpassed 100 subscribers not long ago, so thank you, thank you, thank you. If you like this type of content, go ahead, like, comment, subscribe, because it does take me a long time to go ahead and make these videos for you in a digestible way. Thank you so much. See you in the next video.
What a wonderful world.